I'd like to talk to you about different investment account types and which one is right for you. Some people are employed by a corporation, other people are self-employed, and maybe you're a stay-at-home mom and you don't have any employment right now. So let's talk about these different account type strategies and what you can invest in. If you work for a small business or even a huge corporation, most likely you have the opportunity to invest in your company's 401k. That's a pretty common phrase, right? 401k. And I'm sure you've heard with a 401k, the employer matches your contributions up to a certain percent, and that amount that they match is referred to as free money. So anytime free money is part of the conversation, you want to take advantage of that. Now, your 401k account is set up so that you make contributions pre-tax. That lowers your earned income, which is a benefit for your taxes. And the account is going to grow tax deferred over time. So later on, when you're ready to take money out in retirement, the money's going to come out, but it's going to be taxed. Darn it, I hate to break the bad news to you, but the IRS is eventually going to want to get their money. So they are going to tax you when you take the money out at retirement time. But we'll come back to that one because there's a different option for that. We'll discuss it a little bit later. So the next strategy is, okay, I'm employed, but I'm employed not by a company, but by the state, maybe like a teacher. So teachers, clergy from the churches, and certain nonprofits have an account called the 403B plan. It works very much like a 401k. It has a neat twist to it. With the 403B, you can actually take loans out on the account. You need to be very careful if you take a loan on your own money because you're putting it in there for your retirement, and you want to make sure that you pay yourself back within the time parameters that are allowed, which is 5 years. But that is kind of a neat opportunity for people to be able to get a little bit of cash out if needed. Now the 403B account, just like the 401k, you put money in pre-tax, it lowers your earned income, and it's going to grow over time tax deferred. Again, wah, 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 that money's going to come out down the road in retirement and you're going to have to pay taxes on it, but that's okay. You're getting your tax break up front right now. So there are some different strategies that go into understanding which type of account is going to be best for you, because do you need to get a tax break today or will you need to get a tax break down the road in retirement? So again, we're going to touch on that, and I'm going to give you a clue. It's called the Roth, but we'll come back to that. Maybe you don't work for a company. Maybe you're self-employed. Well, you too can set up a 401k plan. They are kind of costly to set up and administer over time. So there's two other options for you. You can either set up a SEP, an SEP, SEP, Simplified Employee Pension, or you can set up a simple IRA. With the SEP, you are considered the employer and you're paying yourself, the employee, by putting a percentage of your earned income into the SEP account. But unfortunately, only the employer can put money in. And so there's going to be limitations. It's up to 25% of your earned income with a max of $56,000 a year. But that's still a pretty good contribution amount. The drawback there is if, as the employer, it's just you, a solo practitioner, or it's a mom and pop shop, great. But what if you've got employees that work for you? You have to give them the same contribution amount. So if you were giving yourself, say, 10% contribution to this SEP account, you'd have to give 10% to each of your employees, and that could be costly. So that one might not be the best strategy if you have more than a mom and pop shop or 1 or 2 employees. Another option for the self-employed person is the simple IRA, and it is simple to set up, which is great. The employer can contribute money to the employee's account, and that ranges between 2 and 3% depending on how the plan is set up. Also, the employee can make contributions to the account. That's a little different than the SEP. With the SEP, only the employer could make contributions to the account. But with the simple, you can both contribute to the account. And in 2021, the employee can contribute up to $13,500 in 1 year. And if you're over age 50, you can contribute an additional $3,000, which is considered your catch-up fund. So that's quite a savings that you can invest for your retirement. Just like the other accounts, the 401k, the 403b, and the SEP, you put your money in, it grows tax deferred over time, but down the road in retirement, the IRS wants to get their money back. So you are going to have to pay taxes on the money that's taken out in retirement. If a 401k, 403b, simple, or SEP are not available to you, there's still the opportunity to invest money by putting it into an individual retirement account, or an IRA, also called an IRA. There's a traditional IRA, and then there's the Roth IRA. I told you we were going to come back and talk about the Roth because it has such awesome benefits to you. Gives you a little tax-deferred strategy. With the IRA, or the Roth IRA, the contribution limits aren't quite as generous as it is for the other types of accounts we've already discussed. You can put $6,000 a year into the account, and an additional $1,000 if you're age 50 or older. That's considered your catch-up, so a max of $7,000 a year. But with a traditional IRA, you put the money in and you get a tax deduction. Down the road, you take the money out and you have to pay tax. Well, with the Roth, I told you it had a great deal. With the Roth, you put money in and you don't get a tax break today, but all the money you put in over time and the earnings and the dividends and interest that you receive, all of that money comes out tax-free in retirement as long as you have met two requirements. You're over age 59 and a half, and you've held the account for at least 5 years. So a special side note in regards to Roth. There's traditional style investing and there's Roth style investing. With your 401k and your 403b, there is a Roth strategy available to you. So if you have a 401k, you can actually, if the plan allows, and that's based on how your employer sets it up, but you can actually put part of your money into the traditional side of the Roth of the 401k, and you can also have a contribution going into the Roth 401k. So now you're diversifying your tax situation both today and down the road in retirement. That's great. Thanks for watching this video. If you liked it, go ahead and hit the subscribe button. New content is going to continuously be uploaded to the YouTube channel. And you can also jump on my website, imaginefinancialservices.com. From the contact page, you can click on my Calendly link and book a complimentary first appointment so that we can determine if we'd be a good fit working together. Thanks so much.